Good morning, students. We have been finishing your syllabus. We have actually completed this issue management. Under issue management, we have done issue of government securities. Basically, government securities, we have discussed treasury bill and treasury bond, money market instrument, capital market instrument, and similar instrument issued by the private sector, that is we call debenture, very much similar to the feature-wise treasury bond. And we have learned the features of these instruments. So basically why we have learned this instrument, and when you're working in the investment banking division of any particular organization, so you will have to undertake investment opportunities where to invest. So you will have to consider, you have to evaluate, you have to assess what are the investment opportunities available around you to invest your institution money, your own institution money, or somebody else's money, which is fund management. So you are undertaking fund management as well, right? And your investment banking division, your own funds, your company or your bank own funds also should be invested in profitable manner, which earn more yield. So basically you'll have to take a decision, what are the investment opportunities available around you to invest your money profitably. So basically alternative investment opportunities, we have learned all these subjects. As alternative investment opportunity, for example, when you have money as individual, you go to investing or you go and open a fixed deposit. That's a general pattern. But apart from the investing in a fixed deposit or open a fixed deposit, you have alternative investment opportunities around you. So we have learned several investment opportunities. Some investment opportunities which we have learned are riskier, some are less risk, some are lower risk. So for example, shares, we have learned shares and we have learned how do you invest in shares as well. So it's more risky, so riskier than the investing in government securities or investing in FDs. So then, but the return is quite high, right? Return is quite high. So then you will have to take a decision how much your money will be investing in this particular instrument and how much the risk you can take it. It depends, right? So it basically depends how much you can take it. And under issue management, we have learned how do you issue shares and what are the methods available for you to be listed in the CSC or SCC. And we will be learning, I'll give you some note on the listing requirement as well. And we have learned now these days share market is booming up, right? It has crossed the 8,000 ASI. ASI means one of the criteria, one of the index. We have learned ASI and S&P, all share price index, and S&P 20, and all this information required for you to take decision on investment. How do you invest your money profitably, right? And also we have learned under shares, different types of shares, and also the right issue, bonus issue, share split. Now you must have seen now last week, there were a lot of subdivision. So we have learned now 1 rupee share, 10 rupee share divided into 1. So remember that we have learned the total amount of rupee terms has not changed. Rupee term has not changed. So which one has changed? Now, for example, now if we take this, now say you have 10 rupee share, 1,000. So altogether you have 10,000, right? Now subdivision or share split means you take this one into 1 rupee. So this won't change. How much should be this 10,000? So what happened? Number of shares to be increased. So that is shares subdivision of shares. So what are the implications you have? You have more number of shares. When you have more number of shares, the liquidity is what? Liquidity is high. So the liquidity is high. Okay, sir. Now this chart subdivision is that. So basically what happened, what are the implications you have? So you have more number of shares. When you have more number of shares, you have more liquidity. More people can buy shares. So that's what actually expected, right? So when you have more participants, then the participant can buy more number of shares. Now, and we have been discussing all these things. Now, basically you must be having a kind of idea, and also we have completed the treasury bill calculation. Remember, it's a straightforward calculation. Examiner has not tested so far. And also we have completed the treasury bond calculation. Remember, that is more like similar to our next topic, project appraisal. Based on the cash flows, you take this decision. Now in practical situation, actually share bonds are calculated through a calculator. Now we don't do any manual calculation to calculate this treasury bond, but since we are facing for this exam, you will have to calculate it manually. Remember that last week we have discussed several questions with you all. Number of periods will be decided based on what? The frequency of coupon interest payment. If the coupon interest payment semi-annually, then now say the maturity period is 2 years, coupon is paid semi-annually. So the number of periods then you will have to take according to the semi-annual interest rate. So per year, how many semi-annuals? Two coupons. So then if it is 2 years, if the bond is 2 years, then you have to take 4 periods, right? And also remember that you will have to always take not the initial maturity date, but you have to take the remaining maturity date. So for example, now bond might be, there is a bond, this particular bond was issued 10 years ago. 10 years ago. Now we are in 2000, say we are in 2020. 10 years ago means 2010 only this bond issued. This is a 15-year bond initially. 15-year bond issued in 2010. 15-year bond. So after 15 years only this bond is going to be matured. When was issued? 2010. So actually this bond is to be matured 2025. Now we are in for example, we say we are in 2020. Now another 5 years to come. For the bond calculation, you will have to take not the 15-year but to remaining maturity period. How many? 5 years. If it is 2020, right? If it is 2021, then you have to take 4 years. Please remember only you have to take the remaining maturity period. So that is more important for you to, right? And also remember that when you are calculating this treasury bond, you get the intrinsic value, that is dirty price. So when you are asked to calculate a clean price or accrued price, accrued interest, we have learned that accrued interest means when, but from the last coupon date to the settlement date. From the last coupon date to the settlement date, which part does not belong to the seller? I'm sorry, that part, the coupon interest part does not belong to the buyer. Now what happened? Now all these things we have learned, right? I'm just refreshing you. Now, whatever the thing, irrespective of the purchase date, central bank credit coupon rates to the existing customer available. It doesn't matter after you have taken this particular, you have purchased this particular bond after 2 months, after 3 months. No, whatever the on particular coupon date, whoever who is available on the list, they will credit. But if you want to receive 6-month coupon, for example, if the semi-annual coupon, if the bond is paid, treasury bonds anyway it's semi-annual, right? Debentures, of course, you can have variation. Debenture interest, you can have annual, you can have monthly, you can have quarterly, but government treasury bond is always semi-annual. So we say the government treasury bond you have taken halfway through. Masa hayakata ගෙවනවා නම්, but you have taken after 3 months time, for example. So I have purchased this particular bond after 3 months time, right? So then actually I should receive 3 months coupon interest. I was the owner for 3 months only. So you as the seller, you should receive the previous 3 months interest, but on the coupon date, everything will be credited to my account. 6-month coupon, but which is not entitled for me to have 6 months. Why? I was holding this particular bond 3 months only. So then the balance 3 months, it should go to you. But remember, it doesn't happen. But through the pricing, when you calculate the pricing of particular government instrument, it is adjusted, right? So we have learned this thing. This was tested, and accrued interest part not tested. Treasury bill calculation also not tested. Now basically remember, this is cash flow basis. So cash flow inflows are what? All inflows, right? There is no treasury bond calculation. There is no outflows. Inflow is what? Coupon interest, depending on the periods. And on the maturity, you will be receiving the face value. Coupon interest will be calculated on the face value. So generally we take 100. We are actually finding the per unit cost. Per unit. රුපියල් 100කට ගන්න ප්‍රමාණය හොයාගත්තට පස්සේ රුපියල් 100කට 90 නම් අපිට ආන්සර් එක 90 නම් ඔයා ළඟ තියෙනවා ලක්ෂ 10ක් එනම් 100ට 90යි නම් ලක්ෂ 10ට කීයද 1 million වලට කීයද like that you can find out, but you are actually finding what is the price for 100. So the price can be more than 100, price can be less than 100. So if it is more than 100, we call it a premium. If it is less than 100, it's a discount. So basically, what happened is generally when the new issue comes, treasury bond or debenture, if it is a new issue, only you will be having a par value, that is 100. So otherwise, if the thing is previously issued, you can't have particular pricing of 100. You will be anyway having either discount, either premium, right? If it is a new one, only you will be having 100 par value. Otherwise, so discount premium meaning you have what? Accrued interest. If it is par only, you don't have any accrued interest. If it is par only, you don't have accrued interest. If it is premium or discount, particular bond or debenture has accrued interest. Please keep in mind, right? So basically, that's the recap of what we have done. Now today we are going to Now this is the topic, project appraisal. Now now project is what? Now basically project can be anything. Now it can't, it does not necessarily a project like we call a checkport city project or a construction of a particular building. No, purchasing of a machine is also kind of a project. So what do we find out here? Now basically we are finding out, does this particular project is worthwhile for us to accept? Now actually this is accounting subject. So accountants only do this valuation, so that whether this project is viable for us to accept. So how do you fund this project? Is it from your own money or the company own money or the borrowed money? Which option is viable for us? So how do you calculate this particular? How do you assess? How would you take a decision whether this project is viable or not? Same thing we did in the bond calculation. Same thing we did in the bond calculation. You have different periods. So say now, for example, now if the machine will last for 5 years, you have a 5-year period, 1, 2, 3, 4, 5. And you have what? Inflows. When you use this particular one, when you use this particular one, when you use this particular machine, what are the cash flows you can earn? Now when you put into the production of this particular machine, you can earn something. You can use this particular machine for the production, and production you can sell it in the market, you can have a sale value. And also when you calculate the bonds, the cost was not there, minus cash outflows was not there. But in this particular project appraisal, you have a minus cash flow as well. Why? When you want to purchase this particular instrument or the machine, you'll have to spend something. So you have what? Cash outflows as well. So then you have inflows, you have outflows. Now remember, when you calculate the treasury bond, we didn't have anything year 0. Year 0 means now. But in this particular calculation, you have year 0 figure, which is always generally it's cash outflow. Why? If you want to purchase particular machine, you'll have to pay now. So there is a cash outflow now. 1 year's time, you will be receiving cash inflows by selling this particular product using this machine. And inflows and outflows also you have sometimes during the month. There may be a cost. Remember, these are accounting subject actually. Now, when you take these particular cash inflows and outflows, remember to take only the cash items only. You will not take anything there other than the cash. And also remember to take incremental values as well. That is also important. So we will be not going so far for the calculation this, but only thing you'll have to keep in mind, when you are asked to calculate this particular project. Now there is a syllabus topic for your project appraisal. Now when you are asked to do, only thing you have to keep in mind this one. When a project is given to you, how the project is acceptable, this one you'll have to keep in mind. If the NPV is positive, you accept the project. If the NPV is negative, you don't accept the project. right? You don't accept the project. So basically that is we'll be working on some question with you all, then you can understand it. Same thing, remember that calculating of present value, we have done this, right? In the bond calculation. Now remember, when we do the bonds, we have calculated the we have calculated the present value, and we have year 0, period 1, 2, 3, 4. We didn't have anything in this bond calculation. Remember, we had coupon interest rate. This example 10, 10, 10, 10, and end of the period we had maturity face value. We say 100, and we brought everything into today's term. How did you do this? We have discounted. We have discounted, and we have used a percentage. So what is this percentage? In the bond calculation, we have a required rate of return. For individual, if I want to invest this particular bond, I need at least 20%. So then discount by using 20. Now in this particular project appraisal, same thing, right? There is no any different. Same thing. But in this particular project, you have initially cash outflow. Then you have, like this example, then you have minus figures as well. There may be cash outflow as well. And end of the period, now if it is a machine, you can sell it scrap value. If it is available, you can have whatever. Scrap value, like if it is bond, you will always take maturity period one, so you can have this scrap value. So same thing. There won't be any difference. 10 minus here 4, here 4, here 4. Here you have 19 plus. And then you have to find the discounting factor. We call it cost of capital. WACC. We'll be learning how do we do this. By using this particular percentage, you calculate. Now, if it is year 0, it's always 1. Here only it changes. Remember that if it is 10%, we have 90 something. 1 divided by 1.1. Right? So remember, only the first year it changed. One divided by 1.1. 909. Like that. But I remember in the bond calculation we didn't have anything for this column. Why? We are actually finding how much you have to pay now to purchase this particular bond. But in this case, what do you find out? Whether this project, whether this machine is acceptable for us to purchase. So if you have now say you have a figure here, comes here 10 එක 10 වැඩි කරපුවාම 10යි. 0.990 you have figure here, something like that. So all these things present value. These are present values. NPV means what? All these present values minus this. It's always minus, right? Generally it's minus. There should be a cash flow for you to purchase the initial. So net means you add all these things. Here minus. These are plus. This can be plus or minus, right? Depends. When you add all together with this minus figure, we call it NPV. Net present value. If the net present value is plus, You accept. Why we call NPV, net present value? Here you have a figure for year 0 as well. That's why we call it a net. Otherwise, in the board calculation, you find the present value. There is no NPV there, right? You in the board calculation, you find the present value. But in this project appraisal, you have NPV, right? The net present value. Year 0, you have a minus figure. That's right. If it is project appraisal, then if it is minus plus NPV, you have to find the you accept the project. Otherwise, you reject it. And also some technical words we'll have to learn. And there are two types of risk that is available in your QT as well. You have a business risk and financial risk. Now, there's another kind of risk: systematic risk and unsystematic risk. Now, the business risk is basically what? Where from which state to find out whether this company is go for a business risk by looking at the income statement or the P&L. And if it is financial risk, where do you find out? From the balance sheet, right? You have excess borrowings. Now this is balance sheet, typical balance sheet, right? This you have share capital here, then you have accumulated profit, and you have here the borrowings. Right? Column form. Here you have, for you to understand, I have taken this type asset here. This is fixed asset, this is current asset. This is typical balance sheet, it balances, right? This is borrowings. Now, this is how you call share capital plus accumulated profit or reserves. This is equity. Net worth. This is the net worth. This is the value of the particular company. What is the value of this particular company? Share capital plus reserves. Accumulated profit is also part of reserve. Right? This is equity. Belongs to whom? The owner. If the company has, now say here you have 1,000, here you have 2,000. Excessive borrowing, highly geared. We'll be learning later investment ratios. Highly geared. Is this company heading to financial risk? Possible. More debt. You'll have to pay interest. Then you will be focusing more on the business risk. If the business does not generate adequately pay the interest and other expenses, then you are actually in the trouble of business risk. So by looking at this particular balance sheet, you can decide how much geared of this particular company. Debt equity ratio. Ratios will be learning later, right? More debt than the equity. Highly geared company, right? Can go into trouble. Excessive borrowing is not recommended, but you will have to borrow, right? If it is a company, you will have to borrow. Why? You have expenses, interest expenses. When you have more expenses, you have which benefit? Tax benefit. When you borrow, you have to pay interest, which will be charged to your P&L as expense, as an expense. So then you have, when you have more expense, you have lesser profit. Then you pay less tax. So there is a positive factor also there in borrowing. But excessive borrowing is not recommended. You can't pay this. Can't pay. So by looking at the balance sheet, you can say whether this particular company is heading to financial risk or not. If it is business risk, then you will have to go to the P&L. If the sales have come down, drastically, then you can say that company is heading to business risk. Can say that. And the cost has gone up. Cost of if it is a manufacturing company, buying and selling company, then the gross profit margin has come down. So then you can say that this particular company is going for a business risk as well. So the business risk is that. So the systematic risk is what? There are another types of, right? Business and finance. Now these things can be checked in the exam for 2 marks. Business risk is what? Financial risk is what? And what are the available financial statement for you to understand? And systematic risk, and you have unsystematic risk. Systematic risk is what? It's a common to everybody. We'll be learning later also. Common to everybody. You can't avoid. Can't avoid. Now, for example, interest rate, inflation. Is it common to me or you as well? Everybody. Common to everybody. Now, if you take rainy season. Rainy season for an ice cream seller. Is it common to him only or for us only? Common to him only. Rainy season does not affect to us. We are not in this business of ice cream selling. Ice cream selling. So basically, unsystematic risk. So basically, now if you move on to another business in the rainy season, he doesn't have any risk. So the unsystematic risk can be avoided or not? Yes. Systematic risk you can't avoid. That's a question, not in your exam, but other exams. Systematic risk cannot be avoided. Unsystematic risk you can avoid by diversification. We'll be learning later the terms, right? There are 2 types of risk segregation. 3 types of risk segregation you have, right? Sorry. Now all this you can read it, other things, but I have taken the summary of this. Now don't worry about the ratios. I will be giving investor ratios for you all the latter stage. Then everything will be covered. Only thing, remember the financial risk is basically measured by the debt equity ratio. The gearing. How much this company is geared, meaning compared to the equity, compared to the share capital, how much borrowings are there? How much borrowings are there? You can read this. Now this is purchasing a machine is also project. Salient features of income. Right. Now if it is a company, we have now this we have non particular calculation, particular example on the board. Now remember when you purchase a machine, there will be in cash inflows, there will be cash outflows, right? And year 0 you have outflow. Year 0 you have outflow. Then what do? You add column wise, take an answer, and you have to discount it. Now in the first place, now this discounting word we have come across when we are doing the treasury bond calculation. Now we know, we are a little familiar. There you have been given in the exam. This is the required rate of return of this particular investor. Then you use this particular percentage to calculate or the discount the cash flows for the bond calculation. Then you find out the pricing. How much you will have to pay for you to acquire or for you to purchase this particular bond or debenture. Now in this case, Sometimes examiner can ask you to find out the percentage. Which percentage? Discounting percentage. Generally here we call it WACC, weighted average cost of capital. If it is a company, there is a cost of borrowing. There is a cost of equity. Now, if you take a company, I just drawn it, share capital, then you have accumulated profit, which is reserves. There is a cost of it. Borrowing, you have a cost. Company has to pay interest expenses. Company have to pay the interest. Cost of borrowing. Which one? Interest. Cost of equity. What is that? Dividend. So all these things taken together, then you have cost of capital. Or WACC, weighted average cost of capital. Now weighted, why the weighted has come? If the company has equity and the borrowing, you weight it percentage wise. Weighted word also we have learned, familiar word. Where did we have it? This weighted average treasury bill rate. Weighted average. 10 primary dealers can put bids. So there won't be one particular rate. But ultimately, central bank publish only 3 months, one particular rate. Why? There should be a one. So then, whatever the things you receive from the primary dealer, you weight it. Entire thing. 1,000 has received at 10%, 2,000 has received 12%. You all together, you weight it. If you want to purchase, if you are accepting from the central bank side, you are accepting. If it is okay for you all, you accept and put a one figure, the average figure. There we have learned. But here also the similar. We have different types of source of funding. Borrowing is a source of funding. Equity is source of funding. Then you will have to find out what's the percentage wise the weighted. Now remember, cost of capital generally consists of two, generally, equity and the debt. Preference shares is also part of the borrowing, but it is not treated as borrowing. It's a hybrid one, similar to the shares, similar to the borrowing, right? So basically, I have put this as cost of share of preference shares separately, but same calculation we'll have to do. This borrowing. Now, cost of equity. Owners put money. Owners put money. If you take particular company, owners put money. How do you call it? Capital. If the company makes profit, belongs to whom? Owners. So what are the methods of raising funds for a company? Examiner can test you. What are the sources of raising funds for a company? One thing is share issue. Remember, share issue. New shares to be issued. When the new shares issued, what is the implication we have learned for the existing shareholders? Their shareholding percentage will be diluted. They don't like sometimes. So then you have another method to source funds for a particular company. Right issue. To whom? Right issue is to whom? To the existing shareholders at a discounted price, below the market price, below the market trading price. Source of fund, finding the finance to the company. Bonus issue, correct or wrong? It's wrong. By issuing bonus shares, you won't get, the company does not get any cash. only the reserve movement. Reserves වල තිබිලා share capital එකට යනවා. Now reserves and the share capital on the same side, right? Now you saw previously the balance sheet. Only the location change. What else you have to raise funds for a particular company? Debenture, corporate bonds. Those are borrowings, right? Share issue, you can say IPO. If it is not previously issued, if it is previously issued, you can list it. Shares in issue. Now we have learned several listing types as well. Remember these things, right? Just to revise. Your exam is, I think it's June, but you have enough and more time. But keep in mind, actually refreshing what we have learned also, then you can little familiar. All right. Now coming back to this. Now see, those are the source of funds for the company to available. Now, for example, if you say now IPO means prospect issue, same similar thing. When you go for IPO, you'll have to issue prospect as well, right? Okay. Now, and last week also, remember I just told you subdivision happened. Some Haleys and the products, several shares. So basically, the intention is to have more number of shares. Then when you have more number of shares in the market, the share market, then more people can buy, more liquidity. So that's the intention, right? Remember that. Subdivision of shares, share split. So the cost of equity, how do you find out the cost of equity for a company? There are two methods for you to calculate. One thing is dividend. The other one is CAPM, capital asset pricing model. Capital asset pricing model and the dividend model both tested. Examiner has given you a project appraisal and he wanted you to calculate and find out the discounting factor and find this project is viable or not. So two things, a 5-mark question, little lengthy question. And the examiner has given you CAPM formula. Formula is not given in your exam. Basically the criteria for you to apply CAPM formula. Now see growth. Now dividend. Now dividend is basically what? The compensation for the cost of equity, cost of share capital. Now see, if it is no growth, means what? Now this year you have paid 2 rupees per share. Next year you are maintaining the same 2 rupees. You have not increased, you have not decreased. 2 rupees. Continuously you pay 2 rupees per share, 2 rupees per share, 2 rupees per share. Then no growth. If it is no growth, this is the formula for you to apply. D means dividend, P means price. Dividend per share divided by price per share. Then you have required rate of return for what? Cost of equity equivalent. Then if it is growth, you have the formula gets what? Additional one, growth. Straightforward, only thing just to remember. That's easy. Only G plus G comes with a growth. Right? Same thing. And CAPM formula also keep in mind, risk-free rate, examiner can give you treasury bill rate. Beta is anyway given. Beta is the measure of systematic risk. Now, which I have told you now, systematic risk cannot be avoided. If you decided to go for investment, then add something for it, which you cannot be avoided, which you can't avoid. So then add something. How do you find out the systematic risk as a number? Using beta. Beta is the measurement of systematic risk. Market return. Market return. So sorry about it, right? Now see, now risk-free rate. So the beta, return, and risk-free rate. So only the application of criteria for the formula, right? But you have to keep in mind the formula. Now this is the cost of debt. Now see the difference, cost of capital and the cost of debt. Straightforward, but there is a difference. Which one? T has come. T means tax. So the borrowing is good for a particular company. Why? You pay interest expense, which leads to reduce your profit. As a result, you pay less tax. So the tax benefit is there when you borrow. Tax benefit is there when you borrow. So the tax implication or the tax impact, anyway, you should adjust when you calculate cost of debt. Preferentials, of course, is direct. If the examiner gives you separately, you can take it. Right? Straightforward calculation. And there is another method with growth. We have DuPont method. Now, with growth in the sense, now continuously there is a growth. With growth, continuously there is a growth. DuPont means what? For a particular period, there is a growth, again constant. There may be question later, then there was a question. When you're doing the question, we'll be attempting to that question. I have not included here. So when you're doing the question, examiner has tested that the DuPont part as well. For a particular period, 3 years, 10% growth, and after that it's constant, like that. Now in this, with growth means continuously growth. So remember, it's important, right? This security market line and the CAPM we'll be learning later with this question. And this one I told you, the systematic risk and unsystematic risk. Systematic risk cannot be avoided. Unsystematic risk can be avoided through diversification. Yeah, this is the word, diversification. Examiner can test you, right? So if it is, you can avoid, then you don't want to take into account when you calculate. But if it is not possible for you to avoid, then take some percentage or a figure into the calculation. That's why we have taken the beta calculation. Beta is the measurement of systematic risk, right? This is again the formula explaining. And also remember, in the exams, instead of this, market return minus risk-free rate, market return minus risk-free rate. anything you pay now, for example, now see, now treasury bill 1 year, we say it's 5%, which is risk-free investment. Customer comes to your bank to open a fixed deposit 1 year, you pay less than 5% to more than 5%. Generally, you pay more than 5%. We say 6%. Example. So the 1% above, 1% more you pay above the treasury bill rate. Why do you pay more? Say you are a very good bank, reputed bank, AAA rating bank. So why you pay more than the treasury bill 1 year rate? AAA. Remember, we have learned credit rating agencies. We'll be learning later in detail the credit rating agencies. So you pay more. Why you pay more? Why you are carrying a risk? Your bank is carrying a risk. So now I need more. As investor, I need more. Then you pay more 1%, more than you pay 1% more than the treasury bill rate. So which is we call premium. You pay me a premium. Which premium? Risk premium. By investing in your bank, I am taking a risk. By investing in the government, I am not taking a risk. If it is a risky investment, you pay something more to me for me to invest in your particular organization. So that's the no. That's how you pay more. So under deposit insurance, you have limited amount of paying. You can't pay entire, right? Now it's 600. It is not mistaken, 600,000. So if you put 1 million, you can't get the 1 million back if the company or the bank is bankrupt. Now say you pay more, why the balance is what the risk premium. Risk premium. In the exam, if you are given a risk premium, instead of these two, take that return of market return and the risk-free rate, meaning risk premium. This one. A lot of exams, they are not giving, they are giving only the market risk premium, market premium. So take that. Don't find out, don't look for market return. Instead of they can give, now risk-free rate anyway they'll have to give. Here the risk-free rate has to be applied. The market return may not be given in the exam. Instead of they can give market risk premium. The market risk premium is very similar to this part. Okay. And now this is only an application of, right? I will be not taking this is beta. Now see, this beta is also important. We'll be learning later. Beta 1, beta less than 1, beta more than 1. If it is beta more than 1 means it's aggressive. It is important when you investing or calculating a share pricing. You decide which shares to be invested. So the beta value is important. The market performance, the beta is higher than the ones aggressive shares. It grows more than the market performance. Market take 10% now. This particular share again of 15% aggressive, more than 1%. That also can be happen, right? This is only application, so I have not taken this particular, only the application. 8% into 0.2, this is a probability. Now all these things comes to one different scenario. I have taken some questions with you all, then we can complete. This is only just for a completion of part. Beta above 1 implies high risk, aggressive shares, right? And high beta value in rising market and how low beta value good in declining in the market. So same thing I have just explained to you, everything available in your notes. Just by looking at the beta, we can say this is an aggressive share or this is a less aggressive share. If it is more than 1, not percent, right? It's a 1. 1 means that, right? And also I need to discuss with you these two concepts: required rate of return and expected return. There are some relationships we'll have to learn. Expect, require rate. Now remember we have learned one relationship with you all so far. That is price and the yield in relation to government securities. And also I like to discuss with you rating agencies. We will have a small session on rating agencies. Rating agencies, there are 3 rating agencies available in the world: Standard and Poor, Fitch Rating, and Moody's. Now in Sri Lanka we have Fitch Rating, and we have another rating agency called ICRA in Sri Lanka, right? Now those are the 3 agencies globally available: Moody's, Fitch, and S&P. So what does it give you? What does it give? Rating agencies, what is their task? Giving an independent opinion on the credit rating. They actually given the credit rating. Now, you know, in September, Sri Lanka was downgraded by Moody. And November, we have been downgraded by Fitch. And December, we have been downgraded by S&P. So all 3 global rating agencies downgraded Sri Lanka. We were at B-, now we at CCC category. So what does it mean? Basically, you are giving a signal to the investors who is expecting to invest in Sri Lanka. Look here, Sri Lanka's debt repayment is in little trouble. So basically, when you put into the C category, means it's a high risk speculative, high risk category. So that is your call whether you will be still investing in Sri Lanka. So basically, now if you take a particular bank, a particular instrument, debenture, when a debenture is issued in your organization or a bank, there is a separate rating for that. So what does it give? If I am the investor, I don't know anything about your company, about your bank. Inside, I don't know. But independent body has given me assurance this particular instrument is rated this. Now the highest rating is AAA. Like that, you have a double A, then you have A, then you have a double A minus, double A minus, double A plus, like that. Then you have A, B, then you have then C. D means default. There is a pattern of credit ratings. So each rating denotes something. Your default. Now say the last one is default. So the A is the highest, triple A is the highest, then the B, then the C, then the D. So then we are in C now, right? So the next is default. So then it is important for us to get an idea of the third party instrument, third party view. Hello. So the importance of credit rating is that giving a third party independent view for the investor to take a decision, right? Now, right, for your information, I think we have done this also. I just wanted to revise your refreshment, revise your knowledge, to refresh your knowledge. Now see, required rate of return and expected rate of return. Now, required rate of return, now we know why. When you calculate the treasury bond, we have learned this. Required rate of return. This is what I need. No, I need this much if I want to invest in this particular instrument. That is my required. Now, if you take expected return, particular instrument gives this much, irrespective of your choice, irrespective of your intention. This particular instrument gives this percentage. You match with your one. You match with your required rate of return with this particular instrument. It tells itself gives one. Then you decide to put it. Now see the relationship between these two. If the CAPM requires, CAPM calculated what? Expected rate or required rate of return? Required rate of return. For whom? Individual? No, for a company. Individual එක beta. Individual you just compare with the මම මේකේ දැම්මොත් මේකේ දැම්මොත් 10ක් හම්බ වෙනවා. මම මේ ඉන්ස්ට්‍රුමන්ට් එක දැම්මොත් මට 12ක් ඕනේ. 10ක් හම්බ වෙනවනම් මට වඩා වැඩි. You just decide, you compare and decide. Now particular company if you take, there is a cost of capital, cost of equity, cost of debt. So CAPM is calculate required rate of return for a company. If the CAPM requires 10% and you are expected to return 9%, now say you need 10%. හැබැයි මේ ඉන්ස්ට්‍රුමන්ට් එක දෙන්නේ කීයද? 9%. Expected return 9. Do you buy? Your expectation is more than the instrument expectation. You don't buy. If it is not buying, now remember the earlier also we have learned some overvalue, undervalue. If it is overvalue, you don't buy. If it is undervalue, only you buy. Same relationship available here as well. Required rate of return for a particular company 10%, but the particular instrument gives only 9%. Your expectation is more than the particular instrument expectation, then overvalue. Don't buy. Don't buy. Why don't you buy? It's overvalue. There is no potential for you to grow. Right? Similar. Understand this, right? This is important. Not tested. This is not tested by the examiner. This government securities price yield relationship regard to the government securities also not tested. So relationship not tested, and this can be tested for 2-mark question. That's possible, right? Or keep in mind, right? Yield curve we have learned previously. This is previous tip also they have uploaded. This is not necessary. We have previously last week we have done. Last week we have done this, right? Just to read it for you all. Any question you have? I have given them some question on this. Doesn't matter. Now I will be taking some questions, examination question with you all this uh, dividend growth model and the CAPM. So straight away we will move on to the questions. I have given some questions. They haven't uploaded. I will upload it, and only thing you have to apply to the formula only. But examination questions there is like different. So as I told you, examiner has once tested, given some cash flows, and also you are required to calculate the discounting factor as well by using the CAPM. So then you discount it. It's a lengthy calculation for 5 marks. Sometimes you know the calculation only you can do this, but it's very easy. Very easy calculation if you know the subject. The discounting factor, if the examiner has not given the discounting factor, how do you find out? There are two methods. Discounting factor means cost of again weighted average cost of capital, cost of equity, and the cost of debt. Summation of these two. We are given now, for example, if you are given two types. Now see, and if you are given in the exam, if you are given cost of equity 10% in the exam, an examiner asks you to calculate this sometimes. How do you calculate? We have learned two methods, dividend and CAPM. And cost of debt, we say 15%. Given. And examiner asks you to, there is a cash flow here, and examiner asks you to calculate. And you have been given the balance sheet as well. Share capital 1000, and you have borrowings 500. Total is, you can see, right? Total is 1500. Total is 1500. So these are the questions can come. So then you have been given two things. But if you want to discount, you have to take one particular percentage. So how do you find out the one particular percentage? Like weighted 3 months treasury bill, only one particular rate is released. Cost of preference shares, so how do you do this? How do you weight it? Simple. 1000 is out of 1500 is cost of equity into 1500 dwelling 1000 equity into 15 into 500. This is borrowings, right? borrowings. So the cost of debt examiner has calculated for you, but they are asking you to find out the one particular 500 out of 1500. 1500ක් තමයි දෙත්. 1500ක් equity. And then you weight it. How do you do this? Like we did in treasury bill. So when you take a particular one, this is how you weigh. Now there may be some addition to this. This can be cost of preference shares as well. So they can give you whatever percentage here. And there should be a part of preference shares as well. Then it depends. It depends. Basically, it depends. Now, when you want to calculate it, generally examiner tells you to calculate cost of equity instead of calculated figure. Only thing you have to weight it. Now, this is the balance sheet. $1,000 is the share capital out of 1,500. So then the cost is given 10%. So how do you calculate this one, particular one? Now I have given some questions for you to refresh what we have done so far. What we have done so far. This is actually this particular questions actually we need to do it in the class, but due to this present situation, it's actually this was given previously. The previous class also the same question was given. So your syllabus has not been changed so far, right? Syllabus has not been changed. Just to refresh your knowledge, what we have done so far, it covers everything. Covers everything, right? There are some questions available. There are some questions I have taken from your exam as well, just to show that the amount we have completed, so also lead to some questions as well. So we have comprehensively important part of your syllabus has covered now, which is very important. There are some important topics to come, but these are the important topic. The first topic is very important, issue management in your syllabus, important subject. Now see, we have now characteristics of debt security. This is a question in your exam. Characteristic of debt security. So when you say debt security, suddenly which instrument comes to your mind? You think from the investment bank. You're working in the investment bank. So what are the key characteristics of debt instrument? Now, debt instrument, somebody says in the exam, debt instrument, you always think about debenture. Think about the debenture. Then you write down the debenture features. Simple. Describe the main features of treasury bill treasury. I will be not taking this. If you have go through this, anything you feel uncomfortable, we can do it in the class. Straight away, I have taken from your note as well. Note covers everything. There are some right now. For example, now this margin trading. I think we have done. I can exactly remember when you're doing the. There are some questions as well. Margin trading means what? Margin trading means now, since if you are investing in shares, particular percentage is available for you to invest without paying money. You can generally share brokers are asked you to put money before they purchase on behalf of you, but you have a limit available depending on your portfolio. Portfolio valuation අපි කියමු 50ක් විතර available for you. You can buy this, but you can have it. You can put money later T+2, but you can trade it. There is a margin trading. Keeping your share portfolio as a security, you can learn. You can borrow in the banking terms. Same thing happening. Keeping security as a share portfolio, you borrow. Similar thing, broker gives credit to you. That is margin trade, right? Primary market, secondary market, exam has not tested so far. That is also important, right? Two-way quotes, it's available in your notes under treasury bill. Two-way quotes means buying and selling. So this is important for you to understand. This comes when you're doing the proprietary trading as well, foreign exchange transaction, buying, selling. Here also the buying, selling. Now, only the difference you have to keep in mind under this two-way quotes in relation to government securities go as percentages. Now, proprietary trading or a foreign exchange transaction, it goes as figures. Buying, selling. USD LKR 180, 190 rupee terms. But two-way quotes in relation to government securities, here since we have learned government securities, it is related, this question related to that 6% and 7%. So we know that in Sri Lanka we go by the percentage. So when it is percentage, you'll have to think about the pricing. So how do you do this? Now, if it is, now see now two-way quotes. Now, two-way quotes in the sense, now see, in relation to government securities, can somebody say 650, 7. This is percentage. This is market quote. Now, if you say USD LKR, we say 190, 198. Example. This is a quote. This is your bank quote, not your bank quote. I have interest of this 657% government securities, right? ESEC. The mage salli, if I am the buyer, so generally I invest at a higher percentage or lower percentage. I generally go for higher percentage. So I will select 7%. This is related to government securities, right? I am the buyer. I have money. I will be investing in 7%. This is somebody market in a carrier instrument quote. So I'm checking the market. Some broker has given me this. He has given me this means somebody else has won. Hari in instrument mama camera instrument pricing but in Sri Lanka, if we say pricing, but this is not in LKR, this is percentage terms. That is how we deal with the governments. 7%. Think about the person who is willing to sell this particular instrument. Somebody has to sell it for me to buy. That's correct. Think from the seller side. He will be quoting this. He will be willing to sell this particular instrument. 650 valada 7% valada. Now think. Seller is willing to pay. Seller is willing to sell this government security. Treasury bond. He was holding this. He will be willing to sell this particular government bond at 650 or 7%. Think about what we have learned. Magelanga government instrument yield for me to earn capital gain. Remember we did it. Purchase yield this much. When the interest rate purchase yield this much, 10%, I have purchased. Now the market has moved up to 15%. Hypothetically, interest rates have gone up. Then make a it should be less than am I gaining profit or loss? Loss. Capital loss. When the interest rates have gone up, price should come down. The negative relationship. So then I am the purchaser, I am holding 10%. I like to sell this particular bond if you want to make profit below 10 or above 10. Below 10. Man can make a 9%. That's I'm making profit. Now think about this. This is the particular instrument. The seller is having. He likes to sell this particular instrument 650 to 700. Obviously 650. Right? Puluhan taran man gatte roda palle ham vikuranta da mata one. මේක අපි කියමු gatte ඊට වඩා මේ මොකයි කියලා වෙනක් කියලා. Puluhan taran yield ගත්තාම අඩු වෙන yield එකට තමයි විකුණන්න ඕනේ මම. Why? When the yield has come down, price should go up. දෙකක් තිබ්බහම basically I will be selling, the seller will be selling at this. Whose quote is this? Market quote. This guy is quote. He'll be selling at what? This. And I am gaining. ගත්තේකට අඩුනම මම කියන්නේ පුළුවන් තරම් දෙකේ මේ අර ගත්ත එක ගැන අපි දන්නේම නැහැ. but දෙකක් තියෙනවා 6.7යි. අඩු වෙන්නේ නෝනේ yield එක. මේ දෙකෙන් අඩු කොහොමද? 6.9. obviously I am selling at 650. පුළුවන් තරම් මම loss එකට ගත්තත් loss එක අඩු කරගන්න පුළුවන් 6.8 විකුණුවොත් 4ට වඩා. that we know. So I am selling this guy. He is selling quote. If it is this selling, this buying, obviously, right? Now think about this. This is what? This is on your left hand side. You're always buying, always selling. Now see the difference. In terms of government securities, two-way quotes are different from general quotes. Somebody is selling at this 650 on the left hand side, selling. Somebody is quote selling. Then if I am the buyer, I have to purchase this particular bond at 7. I like to purchase at 7, 9. Mama කැමති මගේ සල්ලි වැඩිපුර invest කරනට percentage wise. I like to invest this particular bond at 7. I need to purchase. Somebody has to sell. Me somebody is selling ekada? No. Somebody selling is this. So then I have to purchase. I have to invest my money at 650. Why? This is the selling quote. Please be clear. Right? This is important. This is the difference. Normally, generally we go buying and selling. Since this is percentage wise, so two-way quotes related to the government securities goes as, right? Any question you have? So when my request is to you try this question at home. These are not difficult questions, right? What we have done only, I have taken from your notes only. So you can, there are some new questions as well, but don't worry. Everything we have done this, right? Right. Any question you have? So this project appraisal, since we have done the theory part, I'll be taking some questions with you all. Please purchase past papers. Please be ready with the past papers. So I will be taking some questions next week. Past paper question, then you have kind of idea before you have enough and more time for you to ready for the exam, but we'll have kind of understanding how the question will arise in your exam. Right? Any question you have? All right, then we will wind up this class. We will be meeting next week, right? Thank you for participation.
Thank you, sir.